The Roth conversion strategy everyone talks about could actually cost you money if you do it wrong. But when coordinated carefully with the right timing and conversion amounts, it may improve long-term tax efficiency over your lifetime. Today, I'm going to show you exactly how this works using a hypothetical example with a $1.5 million IRA and how the math can vary substantially depending on the approach you take. Hi, I'm John Amarino, president of Securus Financial, and I have spent years watching people with the same account balance end up with dramatically different tax bills in retirement. Not because of luck, but because of a single decision made in a narrow window most people don't know even exists. Meet Robert and Susan. Robert is 62, Susan is 60, and they have $1.5 million sitting in traditional IRAs. They have Social Security coming, a small pension, and they want to spend about $8,000 a month in retirement. On paper, they look fine. But when we ran their numbers 3 different ways, the difference between their best case and worst case outcome was over $400,000. The same hypothetical couple and starting assets produced 3 very different projected outcomes. Here's the worst one first. Robert and Susan retire, start Social Security at 67, and let the IRA sit untouched until required minimum distributions kick in at age 75. Most people view this as a safer, more conservative approach. However, the long-term tax impact may be larger than expected depending on future account growth and income levels. Here's what actually happens while they are waiting. The IRA keeps growing. By the time RMDs start, that $1.5 billion has become closer to $2 million. Now, the IRS steps in. Robert and Susan are forced to take larger and larger withdrawals every single year, whether they need the money or not. Those distributions stack on top of Social Security and pension income. Now they get pushed into higher tax brackets. Medicare premiums spike from IRMA charges. And when we project this out over their lifetime, the total federal income tax bill comes to approximately $900,000. Now, in this projection, the cumulative federal tax costs approach $1 million over their retirement timeline. Now, here is where most people make their second mistake. They hear that number and decide to fix it by going the other direction, converting as aggressively as possible, as fast as possible. Get everything out of the traditional IRA and into Roth territory before the IRS gets more of it. It sounds like a plan, but watch what actually happens. Robert and Susan start converting $300,000 to $400,000 per year. Those conversions push them straight into the 32 and 35% marginal tax brackets. Not only that, but now they trigger IRMA surcharges on Medicare. Their tax bills in those early years are massive. And when we project this scenario out, the final number is actually worse than doing nothing. They end up paying approximately $950,000 in lifetime taxes. In this projection, delaying planning resulted in a cumulative tax cost approaching $1 million, while converting too aggressively resulted in an even higher projected tax cost. Now, there's a third approach that may improve the long-term tax efficiency in some situations. Instead of converting nothing or converting everything, Robert and Susan convert just enough each year to fill the lower tax brackets without spilling into the other ones. Think of it like filling a glass of water right to the brim without letting it overflow. In the years before Social Security kicks in, their taxable income is unusually low. This is a planning window many retirees may overlook. And once Social Security and RMDs begin, the flexibility available during this lower income period may become more limited. During those years, they convert enough to fill the 10 and 12% brackets first, then move into the 22% bracket before topping out at the 24% bracket. They do this precisely year after year for about 8 to 10 years. By the time RMDs start, their traditional IRA balance is a fraction of what it would have been, or their required minimum distributions became more manageable. They remain in a much lower tax bracket for much of their retirement. And their total lifetime federal income tax bill in our projections comes to approximately $510,000. That is over $400,000 less than the do-nothing approach. So the same hypothetical couple and starting assets produce different projected outcomes depending on the strategy they used. Now, if you're sitting there wondering which of these three scenarios your current plan resembles, that question is worth taking seriously. The window Robert and Susan used only exists for a few years, and most people don't know it is there until it is already closed. If you want to run your actual numbers and see where you stand, book a time with me. The link is in the description below. Now, every time I walk through this example, someone raises a couple more questions. The first is about future tax rates. Fair concern. Congress passed legislation in 2025 extending much of the current individual income tax structure beyond 2025. So for now, the current rate structure remains in place. That said, tax law over a 30-year retirement horizon is never truly certain. And that uncertainty is one reason why some retirees consider proactive tax management strategies. When you convert today, you are paying tax at a known rate, a rate you control. Every dollar sitting in a traditional IRA is a dollar that will be taxed at whatever rates exist decades from now when you have far less control. One potential risk of delaying planning is that future required distributions and taxable income may become more difficult to manage over time. The second question is about your kids. And this one surprises people. You see, when most non-spouse beneficiaries inherit a traditional IRA, they have to empty it within 10 years under the new Secure Act rules. Now that sounds manageable until you realize that those 10 years are often during their peak earning years. So your $1 million IRA gets forced into their income right alongside their salary, potentially pushing them into brackets you never intended to fund and making the IRS a bigger beneficiary of your accounts. Now, what if they inherited a Roth IRA? They still have 10 years to empty that account. But qualified Roth distributions generally come out federally income tax free. And with proper planning, your kids have the ability to allow that Roth account to grow tax free for 10 years before they have to empty that account. Did you hear that? That's 10 years of investment growth tax free. Now, for some families, this strategy may provide greater tax control spread out across generations. Now, here's the third question not asked enough. What happens to the taxes of the surviving spouse, the widow or the widower? In most cases, they go up. Say that again? Yes, they go up, and here's how. You see, you can claim married filing jointly in the year of your spouse's death. But then from there on out, you go to a single filer. That means your ordinary tax brackets and your Medicare tax brackets go down, which means less income actually gets you into those higher tax brackets quicker. And the quicker you get into those higher tax brackets, the higher your tax rate is. But a spouse with Roth IRA funds has the ability to access money tax-free and control those ugly widow tax brackets. So is a Roth conversion right for you? Here's the framework for evaluating where you stand. Start by identifying your conversion window, the gap between retirement and when required minimum distributions and full Social Security begin. For many retirees, this may represent one of the lower income periods available for evaluating tax management strategies. Then, map your bracket boundaries precisely. The current 2026 tax thresholds are more predictable under current law, so this is knowable and plannable. Know exactly where the 22% marginal tax bracket ends and the 24% bracket begins. Then account for the ripple effects. Medicare IRMA, Social Security taxation, capital gains, net investment taxes, and state taxes. These do not show up in a simple bracket calculation, but they can dramatically change the optimal conversion amount. And finally, run a multi-decade projection. A conversion that appears expensive in the short term may produce different long-term outcomes when evaluated over a multi-decade retirement horizon. The couples who do this well are not the ones with the most money. They are the ones who found the window, sized their conversions correctly, and ran the full picture before making a move. In some cases, retirees who delay planning may later discover that future required minimum distributions and taxes create larger retirement income challenges than expected. So if you want to find out which category your situation falls into and build a plan before that window narrows, book a time with me. The link is in the description below. See you in the next video.